Good morning, everybody, and welcome to this week's Expert Insight series with Estate Living. So, a better prospect for the SA economy. I feel like maybe I'm saying some swear words when I make that statement, but we are here today to find out a little bit more about a positive, or to be open-minded to a positive outlook for the SA economy. I'm very happy to have with us today the head economist of Old Mutual, Johann Els, who's going to be sitting with us and being part of this discussion with us today. But before we get going, let me just run through a little bit of housekeeping with you. So at the bottom of the webinar, you'll see that there is an icon that says chat. If you click on that chat, it will open up a chat box on the side of your screen. There, just make sure that you've selected the option that says everyone, which means that everybody on the webinar will be able to see your questions. This webinar is also recorded, so for those of you who registered but were unable to attend today, we welcome you as well, and you should be receiving the recording in a few days. So it's great to have that chat recorded as well. So please feel free to add your questions there. That's why we're here today. This is not just a one-way keynote address, but rather an engaging conversation. And just to those of you who have already sent me some questions earlier in the week, I have got them on hand and we will address them throughout the course of this morning. 45 minutes, it goes quite quickly. So let us just, last bit of housekeeping. We will also run 4 polls during the course of the webinar. This is just to get a better understanding of who you are and what your interests are and what you would like to hear within the webinar environment. The first poll has come up now. You can answer that. Once you've answered that, just click on the red toggle, and the same for you, Johann. Just click on the red toggle. It will take that poll away out of your line of sight, and you can continue to enjoy the discussion. Johann, if I could ask you perhaps to introduce yourself and to tell us a little bit about your career path, just so that we can tell our listeners and our attendees today where this point of view is coming from.
Yes, good morning. Thanks, Louise. Thanks very much for the opportunity. Yes, I'm economist at Old Mutual. I've been with Old Mutual since 1991, part of the furniture here. Before that, I worked at Trust Bank. That's part of the constituent banks of ABSA. And then before that, Reserve Bank. I studied at Stellenbosch University, and I've been passionate about economics for a long, long time. Economics is sometimes complicated, but at the core, it's the study of human nature. What you and me want to buy, what you and me want to invest in, what you and me want to do, our spending patterns, what we think of interest rates, what we think of the rand. So it's exciting. It's hugely exciting. The topic today, that there's better prospects. I work in an investment environment, and we all know the basic principles about investment, the need to diversify your investments, the need to invest for the long term. And that's important. And if we're not open to the possibilities that things in South Africa could improve, we might miss out on some investment opportunities. And that you don't want to do, because markets usually start to run ahead. And that is important then to be aware. So this is my view of the world that I'm going to talk to you about today. Better prospects, far better than what we've become used to. And again, you don't have to believe this, but I'm hoping that throughout this morning, I'll give you some evidence of why I think the bad times is probably dying down behind us and the good times are starting. And it might not be great times, but it certainly will be better times.
I think, Johann, let's like we were talking in the preamble, let's first say what everyone's in everyone's mind. You work for Old Mutual. So is your opinion biased to Old Mutual's business strategy?
It's a good question that puts me on the spot, but great question. I've been getting that a lot from clients. Yes, you have to say things are improving because Old Mutual is a South African company. That's what all the big institutions tell their people to say, that things are going to improve. In my case, not true. I'm not linked to any specific investment team. I'm not asked by the company to present a specific view. This is my view, even though they pay my salary. I'm lucky that I'm relatively independent. I'm the only economist here. Nobody tells me what to say, where my research must lead me. I'm not product related, so I'm not here to sell a product. I'm not here to sell Old Mutual. This is my view. It is an investment view, admittedly, because where do we want to invest in the future? And I think that's probably why many people have joined today. Retirees, people on their way to retire, or saving for retiring if you're young. You want to know where things are heading. And again, as I said, if you're not aware of the opportunities and the possibilities, you might miss out in terms of those investments. So totally unbiased, totally my own view. Nobody, my colleagues are welcome to push back against my views, and they do, but hopefully I'll convince them eventually.
Yes, I've certainly learned that this year, that there is the underbelly of the economist groups, that you are in competition with each other often. But just to put our listeners and attendees into a little bit of perspective as well. So Estate Living, we have produced many forms of communication channels, including webinars. We also have our website, digital content, print content, etc. So we started this journey with Johann around our 1st of November printed edition, where we wanted to share with our residential community members information around where we are. So much has happened over the last 18 months. As a business owner myself, as a parent, you have concerns, it certainly has been a challenging time. And I feel that many other business owners and many employees sitting out there today would probably feel the same. So we wanted to bring some insight into everything that has happened. We had just got through the July riots. We were on the brink of going into local government elections. So that it was at that time that we were very fortunate to meet Johann, and for him to produce what started as a content piece, and this particular webinar is a follow-on to that content piece. And when we finished with the webinar, which is recorded, we will marry the two together so that you can sort of see both pieces of content and information. So perhaps, Jan, we can just start with a sort of overview of where this positive perspective is coming from. Give us a little bit of background of what's been going on within South Africa and how you feel that has affected where we are today, before we move into where we think we're going from the future.
So COVID has been a huge interruption. And last year, when we say it's going to be a V-shaped cycle, a sharp collapse in economic activity due to the lockdown nature of that, to a sharp recovery in economic activity on the other hand, due to the opening up of the economies. Many colleagues, friends said to me, how is that possible? We're going to see a collapse, we're going to move onwards from that bottom, and we're not going to recover. I said, no, that's not the example that we've seen in the past. In the global financial crisis in 2008, we saw this type of cycle, collapse, recovery. This time it was more pronounced and was easier to forecast that, given the exact lockdown nature of this COVID crisis. So we've seen that. Negative 6.4% GDP growth in South Africa last year. My forecast is plus 5.6% growth this year. So the story isn't about last year and this year. This is an interruption. So basically, before we start looking forward, we've been coming from a period of stagnating economic growth. So stagnation, that's behind us. That's what's top of mind here. Admittedly, we all focus on the negatives. We tend to see the noise and not look through the noise. And we then tend to forget the better prospects, which we'll come back to in a second. But in 2003, 4, 5, 6, 7, economic growth in South Africa was 5.5% on average per year. great times, great confidence, good leadership. President Thabo Mbeki, Trevor Manuel as Minister of Finance, Peter Mboweni as Governor of the Reserve Bank. Good management of the economy, strong confidence leading to strong growth. Then, admittedly, during the Zuma years, we lost that confidence. Economic growth collapsed. So much so that in the 5 years to 2019, annual average GDP growth was only 1% per year. Now, 1% per year is as good as nothing. So no growth. And that's the reason for behind many of our ills. The high unemployment rate, the poverty that we've seen, and the fiscal problems, the budget deficit blowing up, government debt to GDP ratio exploding. So that's behind ratings downgrades and all the negativity that we've seen. But the point of this article is that that trend is behind us. That stagnation is behind us. Even COVID is behind us. It's now time to take stock of what has happened, basically since President Ramaphosa came to power. What has happened? What does that mean for the next few years?
Sorry. Okay. So what does that mean? So we're now in a position where, I mean, can we say COVID is behind us? I mean, there is news of fourth waves and boosters and all of this. I mean, it's almost like COVID disappeared during the elections and has reappeared after the elections.
Fantastic question, but sorry to interrupt you there. It's absolutely, we're talking trends. And yes, there will very likely be a fourth wave of COVID infections. There might be a fifth or sixth wave, but all of those will be far reduced in intensity and thus far reduced in terms of lockdown levels than what we've had over the last 18 months. So we've gone through the bulk of the negative regarding economic impact. I'm not talking about the human suffering part of COVID. I'm talking about economic impact. The bulk of the negative is behind us. We've seen vaccination, and yes, the trend has been slowing, started slow, it's now slowing again. But herd immunity and all of that, going forward, COVID will likely be handled like the seasonal flu. And my base case is that by April, May next year, the state of disaster will be ending. Yes, there'll be waves, but the bulk of the negatives is behind us. But Louise, if I may, let's talk about where we've been and where we're going to. And again, it's not going to be death by PowerPoint. I just wanted to show one slide, and that one slide perhaps summarizes where we've been and what we've coming from and where we're heading. So we've come from, during the Zuma years, from lots of political uncertainty. Think back to those periods when we all stood on the bridges on the highways wanting him to resign. Lots of uncertainty meant lack of economic growth, no focus on policy and policy reform. That policy uncertainty was behind all the negative confidence levels, and thus nobody spent, businesses didn't invest. We come from a period of declining commodity prices, and we are very export heavy in terms of commodities. That's hugely important for us. From rising interest rates, from droughts, from the load shedding, and I think I see all of you thinking, hang on, load shedding starting at 2 o'clock again. We'll talk about that. From delayed COVID vaccination to all of those improving. And once again, it's important, it's not overnight. It's been happening, it will continue to happen. So my point here is that from political and policy uncertainty to an improved political environment, the president far stronger within the ANC than what he was. Not at the best yet, we're moving there. Policy reform gathering some momentum. The higher commodity prices helping, the lower interest rates helping, from the drought to record crops. Load shedding, yes, it's still with us. It's not going to disappear overnight. It's not going to be better tomorrow or next month or maybe not even next year. But the trend is positive in the fact that massive private sector energy investment is coming. 2 years from now, the risk of load shedding will be substantially reduced. So you can see I'm not talking overnight. We're talking a broad trend that's improving. The same with COVID that we just discussed. So from lots of headwinds holding us back to those headwinds dying down, some of them not totally yet, so there's still risks, to some of these turning into tailwinds, pushing us forward. And yes, I know you're thinking, yes, Ace Magashule in politics is still around, but he's far weakened. The president has strengthened. The policy environment, the president's spirit of policy activity towards the end of the second quarter in terms of allowing the private sector self-generation limit to be lifted to 100 megawatts, the private sector involvement in ports, in Transnet. There's a lot of that work, the private sector involvement, which is hugely positive and will eventually lead to better confidence and better growth. So lots of these things starting to work its way through into consumer, business, investor thinking. And then you mentioned the July unrest and the local government elections. That's hugely important. Many individuals, many investors even, and lots of media questions coming through to me saying, but hang on, wouldn't the July unrest and the ANC's loss of support in the local government elections lead to a jump to the left in terms of policies? In other words, let's spend our way out of this. Government spends more on social grants, try to win back voter support, try to pacify those strikers, those unrest people. So no, that hasn't happened. My view was that the unrest, the local government elections could potentially be an inflection point for faster policy reform, a type of radical economic transformation, but not what the left, the Zuma supporters wanted. The better economic policy reform that lead to higher economic growth over time. So before you and me start discussing and you start badgering me with questions and saying, but this and but that, which I welcome, by the way, it helps me to form my opinions. Just a last note on the medium-term budget policy statement last week. Now, I've always viewed the new Minister of Finance, Enoch Godongwana, as very pragmatic. In his days as policy leader at the ANC, he's been the guy that's been pushing back on the leftist policy ideas. Very pragmatic. And then he proved that last week in the medium-term budget policy statement by saying that we have to continue with fiscal consolidation. We absolutely have to get better economic growth through policy reform, because that'll be the better way of working against unemployment, working against poverty, than spending more. So all the market-friendly and right statements, yes, there are always risks. I worry about some of the components within the budget, but the intent is clear from the President, from the Minister of Finance. And a last point, we've got strong institutions. Not even President Zuma tried to fire Reserve Bank governors or Reserve Bank MPC members during his leadership. I mention that because a month ago, the Turkish president fired MPC members of the Turkish Central Bank to engineer rate cuts, despite the fact that Turkish inflation is at 20%. So not even in South Africa under a Zuma leadership did that happen. Of course, it happened back in the 70s under the National Party leadership. That's another point. Also, the fact that the rule of law in South Africa was established as supreme. That's hugely important for foreign investors when they sent the former president to jail. And no, the fact that he's sitting at home and he's out of jail doesn't matter. The principle was established when he was sent to jail by the Constitutional Court. So we stand out amongst emerging markets. And I know the human nature is to focus on the negatives, but again, I want to reinforce that point. From stagnation, from COVID, from fiscal debt default worries, the situation has improved significantly, and going forward, better economic growth, reduced fiscal risk, and hopefully no COVID. So a better environment going forward. which might impact significantly on how you and me want to invest, again, diversified over the medium to long term.
So, okay, all right. So, you speak about, I mean, you talk about policy changes, but there's still rumors of certain policies that kind of come out of the woodworks and disappear. I mean, I think it mentioned the Reserve Bank, wasn't it at one stage? Did they not want to make the Reserve Bank not a public entity? What's the opposite?
Sorry, to nationalize the Reserve Bank. If I may, a storm in a teacup. Our Reserve Bank is one of the unique cases in the world where they've got some private shares, some private ownership. If you nationalize the Reserve Bank, it wouldn't impact on economic policy. The Reserve Bank Act and the Constitution dictates that policy making at the central bank is independent of anybody. You, me, government, whoever is in charge of government. So it's not the ownership that matters in terms of policy making. So a storm in a teacup, in my opinion, whether it's owned totally 100% by government or it's got some private sector ownership. And the Constitution cannot be changed easily, and the Constitutional Court has shown that they are a great guardian of that Constitution. So not worried about that. You might ask about prescribed assets. That was a risk in the past. Enoch Godongwana, as policy head of the ANC, pushed back against that. That's not likely to happen. Nobody's worried about land nationalization or expropriation without compensation anymore. Farmers are buying up large tracts of land because that's also not going to happen. The bad policy ideas come and go, and yes, they impact on you and me in terms of confidence levels, but our government has shown to be pragmatic. As I said, some of these negative stuff didn't even happen under the Zuma years.
I just saw a comment coming in there. Do we think that the new EEE bill will have a significant effect on the SA economy?
I don't know a lot about the details of that, but I don't think so. From time to time, from sector to sector, it might impact negatively on confidence. But again, when an economy is improving or on an upward path, then this is some of that, what I would label the noise around us. I don't think that's going to have a huge impact in terms of where we're heading. So no, I don't think it's going to have a significant impact on the broader economy.
So if we look at, we understand that policy reform is a big part. It's a big part in the medium to long term growth. So could you highlight a couple areas where you see this policy reform happening? And we talk about policy reform, but could you get a little bit more specific because policy reform areas, we understand infrastructure. So looking at alternative energy solutions, that's been a major player. I think the energy industry has been pushing for that for quite some time. So that is a great step in that direction. I mean, could we say that the newly established income that's coming out of the G8 summit, that it was 130 billion? Am I correct in saying?
That's correct. Yes.
Will that reach the hands of the private sector? Do we see that going into infrastructure development?
So absolutely, on that last point first, that 130 billion is absolutely targeted at not only green energy, wind farms and solar plants, etc., where the private sector is more heavily involved, but also in terms of the distribution network for electricity, where we need to fix that and expand that significantly in order to be able to transmit that new electricity coming online. So people have been focusing on the generation of electricity, but not so much on the distribution network. But talking about the private sector, part of these policy reforms that's in the pipeline for some time already, and has been gaining some momentum, is the private sector involvement in the economy. in electricity generation, in the ports, in other areas, in Transnet. A big part of the private sector involvement is in infrastructure. And of course, the private sector will only invest in infrastructure if they're able to make some profit out of it. So a big part of the new finance minister's target has been lowering the cost of business, reducing red tape in terms of starting or running a business. There's been lots of changes in terms of South Africa's investment regulations that will also help on the infrastructure part. Lots of these things is stuff that will impact potential positively on confidence, investor confidence, business confidence, the corruption fight. And I can immediately hear everybody listening thinking, yes, but there's still lots of corruption. Yes, again, it's the trend. With Shamila Batoy at the National Prosecuting Authority, she has admitted it takes some time, but they're making some headway. A lot of these areas, Louise, it's not that we've made significant progress already. It's the fact that we've started that process and we're busy fighting the fight. There's lots of work being done in terms of attracting skilled immigrants, improving trade with other countries to the north of us. The minister last week in the MTBPS again mentioned the spectrum sale. They're busy working on an Eskom debt solution. So there's lots of areas where it hangs around getting the private sector involved, making it easier to do and run a business, making it easier to export, to trade, to get the skills to run the economy, things like that. And those are the important things that will gradually drive this. We need more, of course. I said we're going from 1% growth over the 5 years to 2019 to 2.5% growth over the medium term. It's not great. It's not the 4% to 5% that we want. But 2.5 is more than double the 1. So absolutely, I will take 2.5 if I can get it. 2.5% growth will start to make inroads into poverty, into employment, into the budget position, into how you and me feel about the economy, in terms of how businesses feel about the economy. So these policy measures in the pipeline involving the private sector, getting them to see and experience 2.5% growth versus 1% growth. More and more private sector investment coming. And remember, the economy is a circular effect. Better growth impacts confidence, that impacts how you and me spend more, that impacts how businesses will have to invest more, employ more people, buy more machinery and equipment, build extra factories, employ more people, pay more taxes, etc. So it's the circular effect that once it takes hold, that tide that lifts all boats. So it's not, again, I have to warn, it's not overnight. There are lots of risks around this, but we've come from a stagnation view to an improving trend. And again, you've said it, I've said it, it's the trend in terms of we've probably been at the bottom. We're busy lifting out of the doldrums and onto an improving trend, which will eventually get foreign investors involved in South Africa again. Foreign investors are still willing to invest in Argentina, a country that's defaulted on its government debt numerous times over the last 100 years. They're still willing to invest in Turkey, a country that has got a president that fires the Reserve Bank employees to engineer a rate cut. South Africa stands out amongst emerging economies in many respects. To some extent, that's also why the currency is so volatile, because we're the first port of call for new investments. But when there's trouble in other emerging markets, they disinvest from South Africa. Because of our sophisticated financial markets, they can easily get their money in and get it out. The underlying trend in terms of that policy is improving. And gradually that will build on other areas that will improve other areas as well.
You know, I hear what you're saying, absolutely. And I look at the chat there in the corner and some of the questions that come in, and I think about my own personal experiences. Can we keep our businesses going long enough, facing the fact that the power is off and there's issues with trying to get goods and all the kind of labor-related issues? Can our businesses keep going long enough to be able to experience some of this positive trends that you're talking about? Because that is there are the day-to-day challenges that we're faced in a simple process of trying to produce this webinar. We had load shedding, we've had a number of challenges. And I suppose that really brings us to a question that came in through our questions is it worth us keeping our businesses in South Africa? Is it worth us keeping our money, or should we, can we afford to remain invested in South Africa?
Absolutely. We're humans, we're resilient, we see opportunities to make money. If you let go of your business, somebody else will make money out of that same type of business. That is very true. Even in the most poor countries in this world, people are making money. It might as well be you and me. So absolutely, you don't have to wait for the better environment. And when it's difficult running a business, when there's little business around, you run it lean and mean with as little cost as possible. There comes a time when things start improving and when you can expand on their business. There's people that's willing to spend money. One thing that many people don't understand about the lockdown effect last year is that consumer spending, you and me, our spending fell far more than what consumer incomes fell due to unemployment. So lots of people unemployed, so incomes for consumers as a whole fell significantly. But because we sat at home and we couldn't travel and we couldn't go on holidays and we didn't eat out as much, and we probably didn't buy office suits, etc., and sat with our pluckies and shorts before the screens, spending fell far more than incomes. The difference between the two is savings. So savings, consumer savings in South Africa shot up significantly. The Consumer Confidence Survey done by the Bureau of Economic Research at Stellenbosch University, just down the road from me, shows that consumers are feeling far better about their own household finances. So that ties in with that savings that has shot up. So as this economy opens up, not only thanks to COVID opening up, lockdowns ending, etc., people have got money to spend. It's up to you and me to make sure that you run the business that they want to spend that. The other part of that question, take your money offshore. In any investment, you want to be diversified. You probably want some money offshore, you want some money here. But if anybody tells you to take all your money offshore, that's hugely irresponsible. That's hugely irresponsible, because the bulk of us, we make our money here in terms of salary or investments or whatever. We're going to retire in South Africa. Our pensions will be paid out here in South Africa. So if you take all your money offshore and you have to spend it here, that's hugely irresponsible. Plus, if you only halfway believe me that South Africa's got a better environment going forward, better economic growth will mean better asset returns, better investment returns. So you want some of that in your portfolio. My personal view, as an economist, not as a portfolio manager, and I'm not a financial advisor, but this view of better economic environment going forward means that you probably want to be overweight in a balanced portfolio, overweight South Africa. In other words, you will still have some offshore investments, but you'll have the bulk of your investments in South Africa, because emerging markets as a group and South Africa within emerging markets will perform far better. So again, I'm also not saying bring all your money to South Africa. The normal rules of diversification applies, but those people saying take all your money offshore, hugely irresponsible. You have to be diversified. You have to look towards the longer term in any investments.
Just referring now, just to some of the questions that we got during the course of setting up this particular webinar. A question is the South African economy under siege, or is it media propaganda? And I don't like saying media propaganda because I'm a member of the media, but I know what that question implies. Is it the negative talk in the media or is it the negative talk that's being published? Versus, or is our South African economy in the position that under siege, as they've said?
I don't think so. I think that's a label that might have been more appropriate in the middle of the Zuma years. So around 2015, 16, maybe even 17, I would have used that label. But we've come a long way from 2015, 16, 17 to where we are today. A lot has happened in terms of improving stuff under President Ramaphosa. So the media is absolutely doing a great job because they have to highlight these issues, whether it's corruption or bad economic management, etc. I think we've come a long way from stagnation talk towards a better future. We have to take cognizance of the fact that lots of things have improved. So no, I wouldn't use that label anymore.
Another question coming in, which I thought was quite interesting. Despite negative forecasts for the property investment in the near future, there is still a significant amount of development in the pipeline. Empty retail spaces, empty residential apartments. So what is driving this continued investment? And I suppose that's within any sector within the market. If we are seeing a negative, if not, we're seeing a very minimal growth, and we come from a period of stagnation. What is driving these growth nodes? And maybe you can answer that to where you see these growth nodes or these industries of growth opportunity.
So, absolutely, people are seeing opportunities. No country stagnates forever. At some point, the policy environment, the changes that happens or has been happening impacts on economic growth. I suspect that more and more developers, more and more business people are seeing opportunities down the line in terms of growth coming through, etc. So absolutely, again, back to that point, if it's not you and me making the money, somebody else will. So there are people seeing opportunities. Maybe that takes a while. In terms of some of the drivers, I mentioned that consumers are actually in a better financial position than what we think. So they've got money to spend. So down the line, if the economy improves, more people get employed, consumer spending, so the retail environment will probably doing great. But also the fixed investment environment, the infrastructure development, lots of the private sector involvement in those kind of investments. The export sectors will probably be doing well. Talking about the financial sector, if consumers are doing well, banks and financial institutions will probably be doing well. But I suspect the biggest uplift in the very immediate term will be tourism and hospitality, because that's been decimated by the COVID lockdowns. And if we start traveling again, even if only domestically, but we'll probably get a fair share of the foreign tourists again. I mean, that's a big uplift that's probably coming in that sector. So there's a couple of areas that we'll likely see big improvements in.
Coming in again as a question is, bankers are talking about an interest rate hikes, but they say low interest in the future. Consensus from bankers saying shortfall of tax will force the government to increase interest rates. What is your opinion on that statement?
Okay, firstly, just a correction, government has got nothing to do with interest rates. The Reserve Bank is independent and they set interest rates independently of government. So interest rates have got nothing to do with taxes. Yes, interest rates will have to normalize, have to go up at some point because they are very low. And whether they go up tomorrow or only early next year, which is my base case, they will go up very slowly because inflation is under control in South Africa. Inflation expectations, which is potentially usually a big driver of inflation, is very low. The Reserve Bank is still worried about the uneven nature of the economic recovery. So there's lots of factors behind a slow upward path in interest rates. So I'm assuming that interest rates, as I said, will start going up from early next year, about one every quarter. So 8 interest rate increases of 25 basis points each towards the end of 2023. That will leave interest rates at the end of 2023, in 2 years' time, still lower than what they were at the start of the COVID crisis in March 2020. So it's a slow upward path in terms of interest rates. Remember also that you don't invest in cash for your retirement. That's hugely irresponsible. You invest in a diversified portfolio. And if you see a better growth environment, then you overweight growth assets. Growth assets are property and equity. If you invest in cash, you're going to suffer. Don't bet on higher interest rates to get a higher investment return if you invested in cash.
Excuse my ignorant question, but I'm assuming that the increase in interest rates would also then increase the bond repayment rate on a new property. So, should someone be planning to see that increase in that bond repayment?
It's always the best advice, always to try and repay your debt as quickly as possible. So when interest rates go up, of course, that for anybody with any kind of debt, whether it's in property or anywhere, repay your debt as quickly as possible.
So a similar ethos that our finance minister has taken, and there's been a bit of a backlash in the media regarding his proposed budget, which does see the SA debt, the debt of South Africa, being paid back faster, well, as faster than possible. Do you have any thoughts on that?
Absolutely the best way. So that's what I like about conservative budgeting, and absolutely what Treasury and the new Minister of Finance has done in terms of the windfall of significant increased tax receipts this year. Use that to reduce the budget deficit, to reduce the debt burden, because it's that debt burden that foreign investors don't like. Government debt, a share of GDP, probably around and below 80%. Last year, it was around 95% of GDP. If we were a country growing at 5% per year, that would have been okay. But a country that has been growing at 1% per year, that's the risk. So absolutely repaying the debt, the government debt. The budget was hugely positive in that regard, using any possible revenue windfall to repay debt, reduce the budget deficit as quickly as possible, as we all should do in our personal finances.
A last few questions before we wrap it up. A question I didn't quite understand when I mentioned to you, hyperinflation versus disposable income over the next 5 years. I giggled at that. I'm a parent. The disposable income is a myth in my family, but perhaps not in all. So do you have any comments on that?
Yes, absolutely. Yes, people easily talk about hyperinflation. We've had a very low inflation environment in South Africa, a low inflation environment globally. Of course, lots of reasons for that: globalization, technological advances, etc., etc. People now talk about the high oil price, supply chain issues that drives up prices. I don't think that's going to lead to hyperinflation. Hyperinflation is price increases built on price increases towards 20, 30, 40, 50%, 100%. We're not going to see that. There's still lots of competition around, lots of technological advances around. So inflation is temporarily spiking. Those price increases in terms of oil price increases, petrol price increases, supply chain issues that force price increases, they are more of a negative in terms of spending, exactly what you said. We spend more on electricity or petrol, we have less to spend elsewhere. It's that more a negative for economic growth because it dampens consumer spending, it dampens business spending. Disposable income, of course, depending on firstly your incomes, taxes. Fortunately, taxes aren't going up. That was positive out of the budget. And then inflation. Inflation means simply we shift there's relative inflation numbers. We shift from spending more on petrol because we have to travel, or less on consumer goods. So food inflation is declining. Consumer goods inflation, like clothing and footwear, like furniture, appliances, cars, are all declining. Of course, inflation is the one area where people argue with me the most. But inflation, you and me have all different inflation rates. The countrywide inflation is an average of 56 million people's individual inflation rates, different baskets because we spend on different areas, not equally across all those populations. And the one magic about inflation, it's a year-on-year percentage change calculation. It doesn't tell you anything about the level of prices. The price of my cell phone rises from 10,000 to 20,000. It's a huge inflation number. But if it stays at 20,000 for a year, the inflation rate of that cell phone is 0%. It's 20,000 divided by 20,000. And that's true of other prices as well. Some prices go up, some prices go down. Inflation is under control. I don't think we're going to see hyperinflation. Inflation is a huge fight for the Reserve Bank. So I fear interest rate increases more than inflation, because our own Reserve Bank, the Federal Reserve in the US, all other central banks will raise interest rates significantly if there's any sign of entrenched hyperinflation. Because they realize this issue, Louise, that you said, it impacts on disposable incomes, and they don't want that. So interest rates will go up significantly more than what we think if there's hyperinflation coming.
And I think our last question, because a couple of people have asked it in the box, and I'm not sure if that's something that you can comment on, cryptocurrencies. So cryptocurrencies were definitely very popular, and kind of, I think the market sort of crashed a little bit, but it seems to be picking up in popularity. I have my opinion on cryptocurrencies. I was wondering what your thoughts are on cryptocurrency.
Firstly, it's not an investment class, so we're not investing in that. Any pension fund in South Africa, it's not regulated. It's not allowed to be forming part of any investment portfolio. I would also steer clear of those. I've known many people who've burnt their fingers and their hands and their arms and their upper torsos through investing in cryptocurrencies. There's a place for them in terms of the blockchain behind the scenes, in terms of, in future, recording transactions in the property market, for instance. Instead of having the deeds office, it'll be stored in the blockchain environment. So there's a room for that. I would steer clear of cryptocurrencies until such time as they're properly regulated by the financial industries in different countries.
So I take it you don't have any crypto. So if you have crypto investments at the moment, the thing is, you've only lost once you've cashed out. There's that. That
is hugely important, what you said there. I don't realize losses, but that comes back briefly to last year when the markets collapsed at the start of the severe lockdown. Many people cashed out their pensions, their investments. You don't cash out at the bottom. Don't realize the losses. Markets have recovered significantly. Just go and look at your pension funds, your investments. They've recovered significantly from the bottoms of last year. That's always a rule that you should stick to. Don't cash out.
Okay, well, that brings us. Thank you very, very much, Johann. That was very interesting, and thank you to everybody who stayed with us all the way through the webinar. As I mentioned, we've recorded, and we will share this recording, so it will give you an opportunity if you'd like to go through any of that information again at your own leisure. Johann, thank you so much. It was very, very interesting to hear your opinion, and I hope that we can do this again in the near future, perhaps in the early first quarter of next year. Let's have a look again, and thank you for your time.
Thank you very much.